Welcome to the Grizzle Gold and Silver Roundtable. Scott, kick it off. Tell them what's in store.
Oh man, could be a better time for gold and silver. They're both among the top performing asset classes this year, and we're mixing it up with experts from across the industry to discuss the most important topics in precious metals. First, this roundtable is sponsored by Goring and Rosenzweig, natural resource investors. You can find their best-in-class commodity forecasts at gorosen.com. Next, we have Blockland Smart Multi-Asset Fund. It's a one-of-a-kind fund invested in scarce assets, high-quality stocks, gold, and Bitcoin. You can visit blocklandfund.com to learn more. Next, we have West Red Lake Gold Mines. They're building the next billion-dollar gold producer in the prolific Red Lake Gold District. And finally, Grizzle Research and Quant Newsletter, using the power of quant and fundamental research to find investment ideas with asymmetric upside. You can visit research.grizzle.com for more. Now let's get into the topics. We're going to be discussing their strategic case for gold with Goring and Rosenzweig and Blockland Multi-Asset. Number 2 is the investment case for silver equities with Vizsla Silver and Outcrop Silver. Number 3, the advantage of mining gold in Canada with West Red Lake Gold. And finally, upside from exploring for gold internationally with Kobo Resources and First Nordic Metals.
Great. Well, let's get right into it with the strategic case for gold. We're kicking it off with Adam Rosenzweig and Jeroen Blockland. It's a great conversation. Let me cut through the topics. First, valuing gold, a historical context, gold demand, emerging markets versus developed markets, gold miners versus physical gold, the golden age for scarce assets, the value of gold as a diversifier, gold versus silver in a portfolio context, the structural decline of Europe, and lastly, the outlook for scarce assets. Let's go.
Sure. So what we like to do is we like to compare the value of gold to some sort of metric for the value of financial assets. And that is, at the highest level, how we tell whether or not gold is overvalued or undervalued, because we're gold bulls right now, but we're not gold bugs. We don't always think gold's a good investment. We don't think it's the panacea to all of society's ills. We think it's an asset. And as an asset, it has a price, and as a price, it has a value. And at times it's overvalued, represents a lousy investment, and at times it's undervalued, it represents a good investment. So one metric that we like to look at is like the total value of all the world's financial stock versus the total value of all the world's above ground gold holdings, which is pretty easy to figure out because the vast majority of gold that's ever been mined is still being circulated today. That's a great metric. It's intuitive, but it takes a lot of work to get the total value of all the financial assets in the world and sum them up on a daily basis, let's say. So we also look on a more real-time basis at the value of the Treasury's gold holdings relative to the value of the monetary base, how many dollars are outstanding, how much of every dollar is backed by gold. And it turns out that over the last 130 years, that relationship has moved in a band, in a cycle that has been very similar to the first one I mentioned, the total financial assets relative to total gold stock. So we use that as a more real-time proxy. And that's telling you, and has been telling you, frankly, for a number of years since the GFC, since we printed money like crazy, that gold is radically undervalued. So typically the band goes from, about 0.15, 15 cents, 10 cents, 15 cents of every dollar being backed by gold, up to $1.70. Believe it or not, there's been times where every dollar has been backed by $1.70 worth of gold. It's crazy. You could sell the gold, buy back all the dollars, and still have half of your monetary base still outstanding. That's how overvalued gold got. And it's overvalued because it went on to be a lousy investment after those periods. Today, it's exactly the opposite. It's the polar opposite. It's pushing 10, 15 cents of every dollar backed by gold. And that is as low as it has really ever been, on par with the 99 low, on par with the 68 low. So, or lower than that, in fact. So gold today is basically as cheap as it's ever been. It was a bit cheaper in 1999 on that metric. And the reason there was that in 1999, you had all the central banks that were forced sellers of gold. And so I'm not sure that we'll get quite as cheap ever again, because they really kind of put their thumb on the scales a little bit, selling huge quantities at any price, being completely price inelastic. But you're not far from that, and you're basically as cheap as you've ever been. If you went back to a normal range, right in the middle of that long-term average, you're probably talking like $5,000-$6,000 an ounce gold. But if you went to the upper end of the range, where you backed every dollar in the U.S. monetary base by $1.70 worth of gold, you would be up to $15,000 an ounce. So very, very, very high numbers. And that's the historical context. So we think gold is really undervalued and represents a good investment. The question, of course, is then getting a little bit more granular on the timing and say, when do you want to step in and get involved? And we think there now the time is certainly now. So you're right, and I'll make a little distinction. The big buying that has happened in the last couple of years has really been, central bank buying, and a lot of that's been emerging market central bank buying. We're now starting to see really strong purchasing from emerging market retail or investors, not the central banks as well. And what's, I think, really interesting about that cohort is that typically, that group of gold buyers is very price sensitive. So they typically will buy on dips. And when you see strength in the gold market, they'll go away altogether. And sometimes they'll actually turn into sellers. So they're very, very, very price sensitive. Of course, central banks are not price sensitive. When they decide to buy gold, they don't ask what's the price. They just want to allocate a certain amount of their reserves into gold. And when they want to sell, they don't care what they're getting out at. So they're the quintessential inelastic buyer and seller. And so what's interesting in this cycle and in the last, 8 or 9 months, has been to see the sustained buying from emerging market retail or emerging market investor demand, despite all-time high prices in gold. You wouldn't be accustomed to seeing that. And you're right, the gold has been coming for the most part over the last couple of years from the Western investors, from the GLDs, from the various physical ETFs. And that is really consistent with a Western playbook to sell gold when real rates are rising or are high. There's the view that there's an opportunity cost to holding gold, which doesn't yield anything. There's also the view that, when real rates are low, it spurs inflation, and you'll have more demand for gold to try to protect against that. So for all those reasons, when real rates rise, historically, Western investors and speculators sell gold and vice versa. So that's what they've been doing. That now seems to have abated as I think people see rate cuts coming in the future. We're not in the business of predicting rate cuts. I think, quietly, Lee and I, whenever 12 out of 12 Bloomberg analysts feel the same way, we're not so convinced. And so obviously at the beginning, everyone was calling for 6 rate cuts this year. We didn't get any, although now in the fourth quarter we might. So the sort of easy answer is that the Western investors will probably start to come back when they sniff rate cuts on the horizon, and I think that's what you're seeing now. So I'll put this 2 ways. You only want to own gold stocks if you think gold's going higher. Gold stocks, managements vary. There's some good ones and some bad ones. I don't think as an industry, they have some magic secret recipe that they would be good investments if the gold price was flat or down. You want to own gold stocks because you want to express a view that gold is going up. And conversely, if you believe that gold is going up, gold stocks tend to be the best way to play them over time. And that's because A, they have earnings leverage, and B, they can get beaten down to the point where they're actually cheap relative to gold at your entry point. So you kind of get this double whammy, right? Even if they were always appropriately valued, if gold went up 50%, their earnings would go up 200%. Earnings leverage offset to some degree by rising costs, but you would get that move. But then you can also buy them at times in the cycles where they're radically undervalued, not only to their own value, but relative to the gold price or the spot gold price. And that's the situation we find ourselves in right now. The reason I think that gold stocks are so cheap relative to gold bullion today is because over the last 2 years, as we've talked about, you have Western liquidation offset by central bank purchasing. But Westerners sell gold bars and gold shares, and central banks only buy gold bars. So the gold shares have been lost in the shuffle, and they have basically been no bid for a period of time. However, that's now creating this massive, or therefore, that's creating this massive value opportunity in them today. And how good is it? Well, we calculate that using at spot gold, and frankly, spot gold of a couple months ago. So it's actually below spot gold today. The gold stocks basically traded, we did an index of, 6 of the larger ones. And to be clear, we prefer actually to be kind of in the mid cap and mid tier development and best asset stories. We don't normally invest in the gold majors, but a lot of people do follow them. So let's use that as our benchmark. We constructed an index of 6 that have been around for 25 years or more, so we can go and compare historical details. And those today have a market cap that's about 0.5%, 0.5 of 1% of the S&P 500. Now, at the market top in 2011, that was 2%, so 4 times higher. And in fact, in 2015 and 1999, which were both bottoms for gold stocks, they were about 0.3%. So we're much closer to a bottom as far as weighting in the indices than we are to a top. And on a percent of NAV basis, they're basically trading at 60% NAV and 40% of what we call their real option value. And that's kind of a neat way of looking at gold stock valuations. You treat them as a string of call options where the strike price is your cash cost, the number of call options you own is your production profile and how many in each year, and obviously the gold price is the spot price. And what that does a good job of is it appreciates the value when gold prices are very low, because you could go back to 99 when gold was $275 an ounce and the industry had cash costs that were $300, and you said, well, what should we pay for the gold stocks today? And in fact, they had negative NPVs because their cash costs were greater than the spot gold price. However, there's obviously value in those stocks, and the reason there's value in those stocks is that if gold prices ever recovered, you would have a huge growth in the equity value of the underlying gold stock. So basically, they had an option value. They were an option, an out-of-the-money call option. So by looking at real option value instead of just a DCF, they move together, obviously, but they give credit at these low points. And when we want to focus on the low points, they, I think, can be very, very instructive. So right now, you're at 40 cents on the dollar real option value, 60 cents on the dollar NAV. That compares to the lows that were made in 2015, and it's cheaper than in 1999. And the big difference, of course, today, right, compared to 2015 and 1999, if you wanted the same level of valuation in 1999, you had to step into a gold market that had spent 20 years falling 80% in price. In 2015, if you wanted to buy something at 60 cents on the dollar NAV, 40 cents on the dollar real option value, you had to step into a gold market that had spent the last 4 years falling 50% in price. So it took quite a bit of courage. Today, to get those same valuations, you have to step into a gold market that's made an all-time high and that we think is going a lot higher. So I think today, on a risk-adjusted valuation basis, which is, something I'm making up as I go along here, doesn't really exist. But, to me, the risk return, you're getting all the return, and it's a far less risky investment because gold is actually showing strength and will continue to over the next 5 to 10 years. That raises another really interesting question, which we've talked about in our latest letter of, what's the cost of being early to these things? And if you can buy, I'll condense it down to one sentence. If you can buy commodity stocks when they're radically undervalued, the cost of being early is actually quite low. So there's a period of time in the 50s when commodity stocks first appeared cheap in 1956, and they didn't really start, having their kind of moment in the sun until 1970. But from 1956 to 1970, 14 years, they actually outperformed the S&P, right? So there was no cost to being early on that trade. And I think the same will be true today. So is it today? Is it next month? I don't know. I think the gold stocks are already showing signs of life, and I think that'll probably continue.
First, so my investment thesis or philosophy is that we live in a debt-driven economy, society, so we need ever more debt to realize our obsession, because that's what it is, with growth. So you see that the debt intensity of all major economies is going up every year. And that means that already the second biggest asset class in the world, that is bonds, which are also represented in nearly all investor portfolios, is getting truly abundant. And with that comes the question of debt sustainability. And you have seen very clearly, I think, that lower interest rates, higher inflation, but that also results in higher realized volatility for bonds, is something that comes with that to realize that debt sustainability. Now, when you add that to the fact that this is the second biggest asset class, the way I think that investors will look at this is, okay, I have this abundant asset class with poor characteristics. What do I have to do to make my portfolio better? Now, then you look up in the dictionary the opposite of abundant, which is scarcity. And so basically, an investor has the task to find scarce assets to replace the abundant one. That is my overarching thesis. This is what I will call the great rebalancing, which has already started. And then on your question, where does gold come in? Well, basically first, because the debt issue is, of course, related to the whole economy, but specifically in recent years to governments and government deficits, and central banks acting upon those deficits by buying more bonds and pushing interest rates down. If you hold that as, let's say, your reference, what should I do? Then it's very logical, and central banks are actually doing this, that gold can be part of the solution of this debt sustainability issue. So last week we had the Central Bank of Poland. They now have 14.5% of their balance sheet is gold, and they want to push it as high as 20%. Now, suppose every central bank in the world does that. We are now at 13% of these balance sheets. Let's say they push it up to 20, 25 or 30%. That means that against all of these treasuries, against all of that money printing, there's now much more actual gold in the vaults of these central banks. And whoever has some recognition of the gold standard that we used to have, and the same applies to investors. So I think also we discussed this. If you look at this Bloomberg Global Aggregate Bond Index, it represents a total market cap of the bonds that are in that index of $66 trillion. The total market cap of gold is $19 trillion. Not 16. I don't know why people continue to work with numbers from 2021, but it's very easy to look up the numbers for 23. And then because the supply of gold is so slow and predictable, it's very easy to have some kind of real-time market capitalization. So it's 90 now. Suppose we go to sleep and we wake up and it doubles. The price of gold doubles. That means we now have $38 trillion worth of gold against still that 66 trillion of bonds. And I think that means that for every dollar of debt out there, there's more gold, or the relative value. And I think this is going to happen. The relative value of scarce assets, with gold being perhaps the biggest example of that, will shape a market-driven gold standard or scarce asset standard that will alleviate, if that is a good word, the debt sustainability issue. And that is what I think. The only thing, if you want to participate in that, if you want to enjoy that, you have to buy actually gold, just like the central banks, in your portfolio. And that is what I do. That's the simple reasoning I have. And I think for a lot of investors, I also invest in Bitcoin, but that gold is perhaps the first step to have some true diversification away from these abundant bonds. So first on the fund's assets. So we have quality stocks. These are stocks of companies that can do something that other companies can't. So they are scarce. Then we have physical gold. And then we have Bitcoin. On your question, which is one of my favorites, I'm a multi-asset investor, and that means you should look at the trinity of good investing, and that is return, risk, and diversification benefit. So what is interesting now? You can create a chart, I've done so, going back to the middle of the 1970s and still show that gold has outperformed bonds. And this, of course, has to do with the major bear market in bonds in 2022 and also the recent rally in gold. But you can now go back 50 years and gold still comes out on top. That's one thing. So on return, gold is equal to or a little bit better than bonds. The second part is volatility. So the realized volatility of bonds is going up. Still, on an absolute level, gold is more volatile, but relative, and this is important from a portfolio context, and you see a spike in bond volatility, whereas equities and gold are actually a little bit less volatile in recent years. So the ratio of these two volatilities, again, if you put that in a mean variance optimization, in some kind of strategic asset allocation model, you also have to put in the data that shows that the volatility is going up. And then third, that is diversification, and basically that means look at correlation. I use a chart that was derived by my ex-colleagues at Robeco that goes back to 1790. So that's a very long chart. And it shows that the average correlation between equities and bonds is positive. It is the 40 years between 1985 until recently. It's after the Volcker 40 years. That is the outlier. You cannot, if you see that chart, you cannot make an argument that the average correlation is negative. It's quite the opposite. Compared to gold, the correlation between equities and gold is most of the time zero, and it is much more stable. So then you go back to the trinity. You have return, you have volatility, and you have diversification benefit. So even without doom scenarios, even without any forward-looking assumptions on what is going to happen to the financial system or all that debt in the system, the hard data is going to push these mean variance optimization data crunchers toward a better diversification. So even if gold and bonds are exactly equal, then it would make sense to have both of them in your portfolio. And as you mentioned, gold is virtually absent and bonds are overowned. So even that will trigger that great rebalance I triggered. And if you then add a little bit forward looking, what could happen to the financial system, what should central banks do to continue debt sustainability, then of course you get even more attracted to gold. But it's not even necessary to get people to move out of bonds into gold. Long answer, but that's it. Yeah, so let's perhaps start with the portfolio context. Silver is a lot more volatile than gold. And what I try to do with quality stocks, Bitcoin and gold, with a standalone are pretty volatile asset classes. I try to make a portfolio that has a volatility level that is comparable to the traditional 60-40 equities bonds portfolio. So I have to do some things to add to that. And silver would make my life more difficult. But from a more philosophical angle, silver does not have the 5,000 year track record of being gold. Also, if you look at silver on central bank balance sheets, so gold is the one that is used to underpin the value of our money, of our transactions, and so on. And the way you can actually derive that for yourself is gold is also more scarce than silver. So, and we're looking for scarce asset classes here. But also, if you look at the value of gold compared to silver relative to how much scarcer it is, then there's a lot of overvalue in gold, which to me confirms that this is the tangible asset class that is basically underpins our money or debt or central bank balance sheet, whatever you want to call it. So that is, I think I will dilute my philosophy by adding silver. I also get the same question about commodities. Commodities are not intrinsically scarce. So this is why I do not add silver into my portfolio, because I think it would make the thesis a little bit less strong. Let's go. Yeah, so let's start with that last part. So I am a European. And Europeans or European policymakers have made a habit of shooting themselves in the foot, not once, not twice. For years, I thought this was pure stupidity because the quality of policymakers is not that great. By now, I sometimes think about why are we doing this? It's so bloody clear that this will hurt the position of Europe and Europeans in the world, but also if you look at their purchasing power or things like that. And I think this has to do with polarization and also extremely unbalanced policy making. Yeah? So if we look at sustainability and climate, this has gone too far. It seems for many people this is the only thing that matters. But I have 2 small children. I want them to have good education, healthcare. There's a big housing problem in many countries in Europe. We have immigration. We have many problems. And I think when you do not balance those, and then you get things like it. And I think the over-regulation on some of these areas is actually crippling European countries from growth. It is completely growth limiting, and in the end we have this obsession with growth. Everybody wants to grow. If that is a good thing is another story, but I think that this is the main reason. The policy making is so skewed that we are left behind. We are literally left behind. At the same time, the rest of the world wants to grow, wants to outgrow us. So we it's like the rolling out the red carpet, right? So I don't know why we do that. So I find it very annoying. The second part, could that theoretically lead to an increase in it for the demand in scarce asset? I think this is not easily to connect, but you could theoretically say, also if you look at my quality stock angle being scarce, that you could say, okay, if there are no champions, because we have in the Netherlands 1 champion, ASML. We have no champions left. If there are no champions, at the end, you will leave the champions and find something else. I think they will move to the US, but theoretically, if you are a scarce adept like me, you could theoretically say, I'm out of these non-scarce assets companies and moving in something else. But I think the regulation and policy making from Europe is just horrendously bad, and that is a much bigger impact, and I'm right inside it, and that does not make me happy most of the time. I think when it comes to gold, yes, real rates and nominal yields are going down. So you already see we are at all-time high, and whenever the demand from all sides basically continues, I think that is the most straightforward way to go. Even though September is also a bad month relatively for gold prices. But this is really short term. The 6 to 12 months, I think, depends on 2 things. The first, do we get a US recession or not? And the jury is out. If you look at some of these labor market numbers, they are coming down quickly. The Federal Reserve made a big mistake by not cutting rates back in July. They should have. So are they going to make up for that? I'm not sure. And you see that there's this big divergence. If we don't get a recession, this is perfect for stocks and we will go up 15% in the next 12 months on average historically, of course. And if it is a recession, then we go down 50% from here historically on average. So it's and I think if you look at things like disposable income, spending, these are not looking recessionary. It's the ISM manufacturing that looks recessionary, but then of course you have all these yield curve analysis. I don't know, but this is a risk, and I also wonder what will happen. Because we talked about European politics, but I think whatever the outcome of the US election is bad for the budget deficit, and there could be some kind of scare. The thing is that central banks are so eager at this point, with inflation not even at target, to cut rates already, that my idea is that if it does turn south or it does looks like a recession, that central banks would do their same thing as they have for the last couple of crises and slowdowns, and they will. So that would be a cushion. The Federal Reserve, the ECB, they now actually have a cushion to implement quickly. And I'm wondering how long they will stick with their narrative. No, but given what inflation did for a couple of years, I think they will, once things start to look red-ish, my guess is, and that is why I'm not entirely negative, but there are certain risks for the 6-12 months. Longer out, my conviction on this whole scarce philosophy is as high as ever. So I think it's abundantly clear. Just look at the data coming in, the news flow, that this is the way to go. But yeah, of course, I can be wrong.
Okay, next up is the investment case for silver equities. You're going to hear from Craig Perry with Vizsla Silver and Ian Harris. He's with Outcrop Silver.
All right, we got a good set of topics here. Let's kick it off with the drivers of the gold-silver ratio. Then we talk about renewable energy demand for silver, the scarcity of quality silver assets, what drivers underpin a valuable silver mine, silver miners, historical drivers for valuation re-rating, silver and gold miners, the M&A cycle, and then we talk about the assets themselves, the Tier 1 silver development of Panuco Silver and Gold Project, and high-grade silver at the Santa Ana Silver Gold Project.
Yeah, absolutely. So that gold and silver ratio, I think, typically closer to 60 is more in line with the market. Whenever we see a metal price rally, precious metals prices rally, gold typically leads silver. So I think that there's a lag there. I think that we're going to see silver really catch up dramatically. The thing we love about silver, of course, is it's not only those great things about gold, a commodity, a currency, a store of value and a hedge, but silver's also a serious commodity, much more so than gold. And the demand drivers for silver are increasingly dramatic. The market is well out of imbalance at the moment. I think we're short about 10, 15, 20% even of primary silver production. So I think we're going to see a real boom in silver prices. Don't be surprised if you see $100 silver in the next year or two. Of course, silver, it's a major battery metal, and one of the key ones, of course, photovoltaic demand is increasing dramatically as we speak. It's the biggest demand driver. I think it's driving silver demand up by 11% year on year. And more to come. I see an article in an Australian paper the other day that Australia is about to build a project in the Northwest Shelf where it's always sunny of 90,000 hectares of solar panels. Extraordinary project, and that energy is going to be cabled to Asia, Southeast Asia. So, that will demand a vast amount of silver in and of itself. So, those demand drivers really, really increasing. It's not going away. And of course, that's offset by so much of what we see in the commodity space, a very, very challenged supply side. Not many discoveries have been made in recent years. Thankfully, we're at the heart of that. We've made a major discovery in Vizsla Silver down at our Panuco project. But those demand drivers, I think we're going to see extraordinary silver prices along with other commodities.
So the first takeaway is that most people don't realize that the majority of silver isn't produced from silver mines. Less than 30% of the world's supply of silver comes from primary silver mines. So when I say primary silver, that means that the majority of the value is silver, right? Many would be shocked that, it's almost the same amount as produced from copper mines. And this is an important point because if there's a rally in silver, right, nobody starts a brand new copper mine because silver price went up, because it's an insignificant amount of their total revenue. So that alone, about 300 million ounces of silver produced actually from silver mines. And there's very few districts in the world where you see it, right? In historical times, the majority came from Peru, Mexico, and then a time Colombia actually was the third largest producer of silver in the world. And so, I think over 50% of the world's silver is produced just from 3 individual countries because it's rare. It really is rare. And so that's a first takeaway. Finding silver and a pure silver play is rare. And then the second takeaway is that makes it more resilient to overall price fluctuations, right? Because different mines don't normally, it doesn't tilt them over because the majority of the revenue isn't actually silver based. So for me, right, when I look at a silver project, I call it the trifecta. And so silver has a little bit of an oddity in it. And I call it its grade, recovery, and payable, right? We forget about the payable piece because at many projects, it's always the same. A big copper mine, it just ships its concentrate to a smelter. It gets a pretty good payable. And if it produces cathode because it's an oxide leaching project, it's a little bit better, but it's, your percentage points. But in silver, right, doré is the best, right? Everybody says doré is the best. Because you get a high payable over 98%. Second best is a precious metal concentrate where it's really being sold for the precious metal content within. But a lot of silver gets sold, even in primary silver projects, as a zinc concentrate or a lead concentrate or some other sulfide concentrate. And in those cases, the payables can be all over the place, right? I personally worked at a copper zinc silver gold mine, and I remember there was times where our zinc we only got paid 50% of it, right? Those were pretty bad times. Like you say, it says on the books it's worth $1, but you only gave me 50 cents. What's going on? So the payable component is more important in silver, right? But if you have high grade, high recovery, and a high payable, you're maintaining that value, right? So you can't always just look at the grade. You also have to look at the recovery, and you have to put that all in because at the end of the day, we get paid what we get paid. That's our revenue, right? So we have to turn, and then the other aspect is obviously the mining method. So it costs X amount of dollars to get something out of the ground, and how much money am I getting for it? Is, there's some basic rules of thumb, whether you're looking at a surface operation or an underground operation. But you put all those things in perspective, and those are the really broad brushes that help evaluate for me as a mining engineer a project.
Yeah, so of course, again, it comes back to some extent that silver is a commodity, and historically, silver was typically the key driver, demand driver was photographic technology. Nowadays, of course, it's photovoltaics and connectivity. So I think a little bit different to gold in that sense, because gold is more of a true, a currency and a store of value and a hedge, as I say, to a lesser extent a commodity. The net asset value of silver companies is an interesting one, and we're seeing that writ large at the moment. We saw a major takeover bid today. First Majestics just announced their acquisition of Gatos. Gatos is trading at a 1.7 times NAV. First Majestics trading at a 1.9 times NAV. The price that First Majestic's paying for Gatos is a 1.9 times NAV. So you're getting much higher NAVs for silver producers. I don't know that I can put my finger on why that is. For some reason, silver, I think, partly it's to do with the commodity side of things. But silver bugs are a different breed of people completely. They're a lot more exuberant and excitable than perhaps the gold bugs, if that's possible. So that's part of it. But you do see a much greater valuation of silver producers, and hence, Visa Silver, we want to bring that project into production as quickly as we can, and for our shareholders capitalise on that differential and that much higher valuation to NAV that you get. Yeah, well, I think you're seeing the M&A cycle kick off writ large. We've seen some bigger deals, of course. Newmont buying Newcrest, that's the sort of granddaddy of them all. Smaller deals happening more and more. I feel like we're at the thin end of the wedge. It reminds me very much of about 2005, during that last boom, early stage of the boom. We saw BHP buy Western Mining, for example. That was the first major acquisition that really kicked off that part of the M&A cycle. I feel like, the Newcrest Newmont deal, probably the first of many, many big deals, and we're starting to see that trickle turn into a steady flow. So a month or so ago, we saw a Cisco mining be acquired by Goldfields. Big deal, another big deal. Now you're seeing the Gatos First Majestic deal. That trickle's starting to turn into a flow, and I think certainly both all precious metals producers, the gold producers need to replenish their reserves and increase their production profile. But that's probably more important for the silver producers nowadays as well. So I think we're about to see the floodgates open. You're going to start seeing and it might not happen, over the coming 6 months, but certainly in the next couple of years, we're going to see M&A really kick off. I've been in corporate development myself as a geologist for the past 25 years, and I know how those big companies operate, how they assess opportunities, and it's only hard to justify acquisitions when prices are low. But now we've got high metal prices, rising metal prices. A sense of FOMO will kick in for those corp dev guys in the majors, and we'll start to see things really kick off here over the next year or two. Yeah, Panuco, it's an extraordinary discovery. I think, as I say, probably the most important silver discovery of the last 20 years. The discovery of the Kapala vein, which is a very thick, typically 11 metres thick vein at very high grades, north of 500 grams per tonne silver, is an extraordinary discovery, and that's what's driving the economic results of the PEA that we put out 2 months ago. The highlight numbers there, very low capex, $220 million US capital cost to get that project into development. Talking about 20 million ounces of production for the first 2 years and about 15 to 15.5 million ounces of production over an 11-year mine life. I would expect that when we do our feasibility study, there's an opportunity to improve that as well. But the extraordinary thing is that at conservative metal prices, the thing has a US NPV of about $1.1 billion. But at today's metal prices, that's about $1.6 billion. So over $2 billion Canadian against a capital budget of about 220 million US. So that delivers an extraordinary internal rate of return, 83%. At consensus metal prices, and well over 100%, so a triple-digit IRR at spot prices. Extraordinary project. I haven't seen an IRR from a project of this scale, of that nature, for many, many years. It's a project that time forgotten away. It's like some of the great discoveries, like Escape Creek, 30 or 40 years ago. The project has a 5-to-1 MPV to capex ratio. Extraordinary, something that I've never really seen before in any mining project. So we're thrilled about how that's looking. It'll be one of the world's great producers when we bring it into production over the next 3 or 4 years. Still, Tom, dramatically undervalued at only $650 million market cap.
So again, I'm a mining engineer, so I like being involved in projects that actually become future mines. And so when I joined Outcrop and Santa Ana, it already had an established resource of 37 million ounces and one of the highest grade deposits in the world. But we're really focused on some key things, right? Demonstrating how we can grow the resource and executing that at a much cheaper than we get value for our ounce in the ground. But we've also advanced the metallurgical test work, and that's what I really get excited about, because we see some of the highest grades in the world, right? Like top 3 grades, top 2, right? In the world. But we're also seeing metallurgical test work that shows a 96% recovery of silver and a 98.5% recovery in gold. 75%, 3/4 of the value is silver. So we are a true primary silver project. And the metallurgical work is showing that we're going to be producing a very high grade precious metal concentrate, to the point where we had some meetings recently at Beaver Creek, and they said, you should smelt that directly, like you would be able to produce doré directly from your own concentrate. So that helps, because I talk about the trifecta: high grade, high recovery, and high payable, and that really bodes well for the project. It gives it strong legs. We know it's going to be decoupled from scale, because each ton should be producing a lot of value. And we're currently on a pathway to demonstrate how this resource could get much, much bigger. So obviously exciting times at Outcrop and the Santa Ana project in Colombia.
Okay, let's keep rolling. Next up, we have the advantage of mining gold in Canada. You're going to hear from Gwen Preston of West Red Lake Gold Mines.
Yeah, so Canada, obviously an important jurisdiction for gold mining. Gwen gives us a lot of insight. Here are the topics we're covering: key advantages of investing in gold mining projects within Canada, the value of having a permitted mine on the cusp of production, the prolific gold mining history of Red Lake, the importance of the Golden Runway for investors. The Golden Runway is within the Lassonde Curve. And then finally, the Madsen mine, which is in the sweet spot of the Golden Runway.
Yeah, for sure. So really important question. The gold equity space has been a little bit dull. I think there's going to be a lot more investor interest coming into the space right now. Where are those dollars going to go? They are going to go preferentially to tier 1 jurisdictions, and Canada is undeniably one of those. So the fact that the dollars go there means that Canadian projects get a higher multiple on their valuation. So that's just a higher return for investors that I think inflow of investor interest is going to make that show up for us increasingly. Now, why do we get that premium? Well, it's because there's rule of law, there's consistent permitting. It may not be fast. It doesn't mean it's going to happen for sure, but at least the rules are consistent. There's currency stability, so you're not tripping up on those, tripping up on currency issues. These stability factors are really important. They're important to the investors, and they're also important to the major mining companies that are looking for new projects to buy. They want to manage their risk. They will spread out and invest in other countries for sure, but in a limited fashion. A lot of them want their bread and butter to be in tier 1 jurisdictions. So you have a higher likelihood of takeout for your project, which at the end of the day is the best exit strategy. You have a lot more stability in all kinds of things, including currency and permitting and rule of law. And that creates a higher valuation multiple for your asset. Oh, absolutely. I mean, the time frames to turn a discovery into a mine just keep getting longer and longer and longer. That length of time, I think, is a huge part of the reason why gold equities have struggled to attract investor attention increasingly over the last decades, because it's hard to have that kind of patience. Money is not patient. And so if you can find stocks to invest in that have somehow managed to shorten that time frame, so whether they've managed to already have permits, they're reviving a historic operation, whatever it might be, being close to production is a rarity in the gold space these days. It's truly a rarity. And I think the big M&A deal that we just saw with Cisco being taken out for $2 billion, phenomenal deal. What was that? That was a major mining company coming in to take out a asset that can be put into production, that is being put into production in this gold market. And the list of those assets, it's not very long. We've had a big bear market. It slowed a lot of projects down. They didn't get to that ready to be developed or under construction status. They just didn't get there. So there's hardly any on that list. So assets that are close to production are rare, and they're especially valuable because it just takes so long to get there. There's been over 30 million ounces of gold pulled out of the rocks of Red Lake. And this isn't an expansive region. This is a reasonably small area that just has a lot of high grade gold in the rocks. And so mining there started over 100 years ago. The Madsen mine that we're developing, mining there started in 1938. And it's been high grade gold that's been pulled out of the ground for now over 100 years. So that creates a bunch of things. It creates a lot of knowledge about how to find gold, how to mine gold in that area. It creates a lot of potential to find more. There's that classic saying in mining: where's the best place to look for a new gold deposit? In the shadow of a head frame, right? Look right beside where you already know that there was gold. And then it also creates this incredible workforce that lives in the area, that knows mining, that understands mining. The community has based in mining. So it creates potential for a lot of synergy. When we post job opportunities, we get a huge number of local applicants, which is great for everyone. So Red Lake is a phenomenal place to work, very supportive, very engaged with mining, and the rocks are, top notch. So the golden runway, like you say, this is this Lassonde curve, right? Value goes up with discovery, then value really falls off a cliff as you go through that long, long period of figuring out how much gold there is, exactly where it is, permitting it, engineering it, financing it. Then you get to, hopefully, for good projects, you get to, let's build this thing. We have a permit, let's go. So from construction decision to pouring gold, that is the period where the value of the asset goes back up. And it should, because you're going from spending money, which is what it takes to delineate and engineer and construct a gold mine, to hopefully making money because you're producing gold. In any sector, if you're increasing your output in a significant way, then you should be worth more. It doesn't matter whether you're making widgets or drugs or whatever it is. You should be worth more if you're producing more, if you've put in the capital investment. That's really what the golden runway is. You've put in the capital investment and the time, and now you're going to start producing gold in this case. And so the value of your stock should rise on that golden runway. And because we went through this crazy bear market where so many gold projects just stalled out, there aren't very many projects that have made it to that golden runway phase right now. It's a pretty short list. So yeah, West Red Lake is incredibly busy right now at the Madsen mine. The golden runway is a very busy time frame, right? Building a mine is a very complicated thing. Our path is a little bit simplified in one sense, which is that a huge number of the things that we need to turn this mine on already are in place. The mill is already built. The tailings dam is already built. The permits are already built. There's a huge amount of underground development. Massive head start on our pathway to production. But we want to make sure that when we make a restart decision, we're doing that on a sound mine plan, on a mine plan where we know exactly where the gold is, how we're going to mine it, and that we have efficient plans for mining that material, moving it, processing it, and producing gold. We want to make sure those things are set up, because that's how you increase your odds of success when you turn on a mine. So we're doing all the work right now to underpin that efficient mine plan. And the next few months are going to be really busy with news. We're going to put out the official mine plan that lays out how much we're going to produce, how much it's going to cost, when it's going to turn on. We are working hard to access the final piece of capital, the last piece of funding, to get ourselves into commercial production. Assuming those things come together, then hopefully we are going to make that official decision to restart the mine. And the goal is to turn this mine back on in 2025.
Last but not least, it's time to talk about exploring for gold internationally. You're going to hear from Paul Sargent with Kobo Resources and Adam Sigelski with First Nordic Metals.
Yeah, great set of topics here. First, we're going to talk about the high-grade gold in West Africa, then Scandinavian gold exploration, Cote d'Ivoire, underexplored versus prolific gold neighbors, the open Greenstone belt, gold mining prospectivity in Sweden, partnering with a global infrastructure giant, Mota-Engil, having a gold mining titan in your corner with Agnico-Eagle, Kobo's exceptional assay results in their fall drilling campaign, and finally, the path ahead for First Nordic's flagship Barsele gold project.
Okay, so yeah, Kobo Resources, we've been in Cote d'Ivoire since 2014, when my partner, Ted Goslin, our CEO, first got involved over there. We got involved in West Africa, and specifically in Cote d'Ivoire, because we saw a huge advantage from both an exploration perspective and frankly, a cost perspective. It's a jurisdiction that's been heavily underexplored. And you look at what's going on now, certainly in the last, sort of 3 or 4 years, you see it starting to catch up with the rest of West Africa, but there's a huge operating advantage for us there. We were first comers to the area. We saw open ground on very attractive geology within the country. We currently have 2 concessions that are issued to us, and we've got 2 more pending. So overall, we'll have almost 1,200 square kilometers of the key target rocks within Cote d'Ivoire. But I think for us in our Cusp Gold project, which is our flagship property, the logistics couldn't be better for us. I mean, we're located 30 kilometers from the capital city of Yamoussoukro. We're only 9 kilometers by road from an operating mine that is will be depleting its resources over the next few years. And so we've got access to assay labs that are again located in Yamoussoukro. And because again these companies have been putting so much energy into the assay labs have been doing so much work in getting up to speed in Cote d'Ivoire. We're getting 3-4 day turnaround in our assay results, which obviously is a cost advantage. We can take advantage of that. And because of all the other activities that are going on in the rest of West Africa, there's a lot of drilling companies and other sort of resource sector consultants that are pulling out of Burkina Faso and Mali and coming into Cote d'Ivoire. So, our direct drill costs in our project, including all of our heavy equipment, assays, and direct drill costs, was about $225 a meter Canadian. So, great turnaround time on our assay results to help us manage our program efficiently. Good access to equipment, people in the city of Yamoussoukro, and very effective exploration costs for us on the project at this point in time.
Scandinavia, the majority of our projects are in Sweden. You've had recent, opening up of the technical opportunities there in the mid 90s. So you really are just getting modern exploration, happening at maybe the last 15, 20 years. You've got consistent, predictable tax structures. You've got tenure, consistent and solid tenure. The government's not going to take away your settings. You're dealing with one of the top economies to be working in, globally, probably. You've got, specifically in our jurisdiction, you've got incredible amounts of green energy. You've got hydroelectric power all over the place. So you've got this incredibly rich geological setting. We have a new government in Sweden now that's obviously very pro mining, has opened up some new mines. I think they're very open to the idea that underground mining is really an exciting way to continue to monetize these mineral opportunities. And when countries have huge geological prospectivity, they need foreign capital, so they treat you well. You get invited to the right types of settings to ensure that your company is successful. You're not getting blocked ultimately by various parties that could be problematic.
Yeah, so Cote d'Ivoire, again, we kind of look at it as being sort of 20, 25 years behind the rest of West Africa. Again, that window is closing now because you are seeing a major influx of mid-size and major companies coming in. 4 or 5 years ago, there were only 4 mines in Cote d'Ivoire. Today I think there's 7 or 8, and we expect another 2 or 3 to come online in the next couple of years. So you're seeing that activity ramping up dramatically, and it's a function of its history. Ghana, has been the I guess the heartland of exploration in West Africa for many, many years. But it's a mature country. There's not much open ground available. You go north to Ghana to Mali and Burkina Faso, and obviously there's a lot of geopolitical issues up there right now, and so that's forcing companies out as well. And so I think everybody is looking at West Africa. I think everybody believes that it's a very attractive place to do exploration. And you look at Cote d'Ivoire again. They updated their mining code in 2016, and that really changed everything. I mean, it put them on a par in many respects with the West Africa and other developed nations as well in terms of security of title and the process and how you claim and all that intricacies that you want to know is embedded in law. And that really changed things, and that's really what got things going, plus the geopolitical issue. So, it has more of the target. So the Birmingham formation is the target formation in West Africa that produces 99% of the gold, and Cote d'Ivoire has 35% of that formation. Yet it only produces, historically 10% of the gold out of that craton. So there's a geological disconnect, and it's simply geopolitics, and that gap is closing now. So you're seeing a lot of companies coming in. There's a lot more junior activity now, but you see a lot more of the intermediates and majors, getting involved in Cote d'Ivoire at the moment as well.
I mean, listen, you've got probably the final frontier of open greenstone belts. We control an entire greenstone belt in Sweden. We have our own greenstone belt in Finland. So, you look at Ontario, Quebec, we have a slide in our presentation that we just put together, and it shows this 100-kilometer trend that we have. It shows that in the middle of this, we have this 2.5 million ounce deposit that is open at depth, probably runs to a couple of kilometers. This thing could be 6-7 million ounces on its own. But if you look at the greenstone belts in general in Scandinavia, and specifically in Sweden, that belt in Ontario has 15 different companies operating. You've got mines being, put into production by Agnico, and you've got 20 companies fighting over little slivers to find, those ounces. You have an entire first order structure controlled by one company. You've got Agnico there that owns 55% of the main asset. And, just looking at like average depths of these mines in other greenstone belts, they go anywhere from 1,500 meters to 3,000 meters. You've got incredible depth plunge potential in these deposits. So greenstone belts in Scandinavia, I think we've had maybe 10 million ounces extracted from these belts in the last 25, 30 years. And now you look at the Abitibi, it's got 200 million plus ounces extracted. So you're talking a sliver of what has been found and taken out of the ground. And that's the real opportunity in going to new jurisdictions and new areas. It's a little bit different than Canada. It's obviously everyone trusts Canada, and we're operating in Canada, so you feel comfortable as a Canadian company being in Canada. But some of these jurisdictions like Sweden and Finland, and these are fantastic countries to be working with, great governments to be working with, skilled labor, people willing to work. It's a dream to be able to operate in these countries.
Yeah, it was a great opportunity for us that we took advantage of after several months of discussions about strategy and what we were trying to do, what they're trying to accomplish. So, yeah, Mota-Engil is a top 15 EPC company in Europe, and they've been in Africa for over 70 years, so they're very well versed. They act as a mining contractor at 9 different mine sites across Africa, 2 of which are in Cote d'Ivoire. So they're very familiar with the operational activities in Cote d'Ivoire. They built the soccer stadium in Abidjan for the recent Africa Cup. They handle a lot of that stuff, sort of road building, dams, just construction sites. They're a big engineering company, and they came to us. They've got about 5 years ago, they made the decision that they wanted to get into the front end, or the back end, I guess, of that whole mining cycle. Instead of just being a contractor, they actually wanted to try to find mining opportunities. So they're commodity agnostic. But when they contacted us, first of all, they really liked our Cusp gold project. They really liked the potential of it. And again, the location next to a mine, that whole story that we've spoken about before. But what they wanted was a group that were effective in their exploration, and they found that in us. And we're kind of like their eyes and ears in West Africa for gold. And again, we're focused on Cote d'Ivoire, but we are looking at things in Ghana. We will look in Senegal and other countries. But again, our main focus is in Cote d'Ivoire. But having them in our back pocket is really a huge advantage to us, because they want us to keep doing what we're doing. That first and foremost, they do not want to come in and change what we're doing, how we're doing things. They like what we do. What they want out of us is to help them find other opportunities. And if we can find those opportunities, it really gives Kobo the ammunition to go out and now act on those things. I mean, I've been involved in the junior sector for many, many years. And it's incredibly frustrating when you see a great opportunity, but you just don't have the cash, or your stock price is just not a point where you can actually affect some kind of deal without shredding your company. These guys are now like a big brother in our back pocket that has the strength to come in. So if we see something we like, we'll make the decision on whether we think it's the right thing to do or not, and go to them and ask them, do you like it as well? How can we kind of wrap this up into a project that we can both benefit from? And that, I think, is what's been missing in this industry for many years. as you know, the majors make all the money. The juniors are always looking for money. Sometimes they fund the juniors, but not often. So now you've got that strategic alliance is going to give us that ability to find new not to find, but to take on new projects if we think they're good. But it also gives us the opportunity to potentially build these things because they have that expertise in-house. So again, that's something else that I think is really unique. And because they don't have any operating mines at the moment, they're very keen and they really want to grow this business. And we're thrilled to have them as a partner moving forward.
They're the elephant, right? They own 55% of our asset. I mean, we have 45% of it. It's a beautiful deposit. It's going to be a mine one day, no doubt. We've run through technical to confirm that. It's Agnico-Eagle. It's the best mining operator in the world. It's when they see a good jurisdiction and a good project, they're very keen to advance it at the right time. So we as a junior company, our relationships evolved with these guys. When we started working with them in 2014, when the discovery was really made, they were a $3-4 billion company. Today they're a $50-60 billion company. And gold goes to $3,000, $4,000 an ounce. They're going to be $100, $120, $150 billion company. So to have a partner that's, I think they just did $500 million in free cash flow last quarter. And, gold goes up another $300-400. That's going to be $1 billion a quarter they're making. So it's tricky because just to get their attention, it's complicated. They've got a board of directors with over 20 people on it, I think. They're very focused on their region here, but they're also fantastic technical partners to be working with. We're going to go to site in a couple of weeks here when we're in Sweden, and we're able to plug in their technical teams. We're able to work with their technical services. We're able to ensure that our data is aligned with their data systems, and that they've been on the ground there for 15 years. So when we find something new, we go and talk to them about it. We bring their technical team into it, and they're brilliant. They're highly involved in the area. They've got all the environmental relationships in place. They've been doing all the studies, the baseline studies that we don't have to even think about. So you're operating, with a Rolls-Royce partner, and the biggest challenge is just trying to keep your ideas, at the top of their priority list, which is really the major challenge. But on the opportunity side, we announced their 13.5% partners, and we're getting calls from New York from guys that own Agnico saying, why did they do this? Right? Like, who are you? And next thing you know, you're on the radar of 50 new family offices that are suddenly saying, hey, is this good? Is this bad? Like, are they diluting their efforts in Sweden? Is this an opportunity? So immediately we got a call from an analyst in New York who's been hosting them, and we got invited to conferences to go and speak. We're now having Agnico as a partner just gets you in the door of so many different people. And, next week's Beaver Creek, I think the number of meetings we got and the ability to present at conferences, it changes, because the first thing you say is you're partnered with one of the best mining companies, if not the best operator in the world.
Yeah, so at Kasuga Gold Project, we got three main targets. We call them the Jagger Zone, the Road Cut Zone, and sort of a newer one we're developing now called the Katy Zone. And collectively we've got probably 6 to 7 kilometers of strike extent on those targets. We've done most of the work on what we call the Jagger Zone. It's about a 2 kilometer long soil geochem anomaly that we first drilled last year. We did about 3,700 meters of RC drilling on it last summer. And this year we followed it up with about a 1,200 meter diamond drilling program on it, just to kind of confirm. But yeah, the grades have been very good. I mean, some of our better RC results were like in hole 11, we got 19 meters at 2 grams per ton. Hole number 2 in the RC program, we got 20 meters of 1.87 grams per ton. And within that, there's some nice high grade hits as well. So we're seeing sort of multi-ounce type grades in there where we've got these major north-south trending shear zones cross-cut by these east-west higher grain quartz carbonate veins. And when you hit that triple junction there, you're getting these really nice high grades. So we were very, very enthusiastic about what we had. The previous trench results were equally as good. So we came back in this year and we did diamond drilling on that because we wanted to build more of the stratigraphy. This isn't a volcanic belt. They're very defined shear zones. But we want to understand better the geology and the orientation of the veins and the shears and this kind of stuff. And, the results, again, were, I think, really quite good. I mean, our first diamond drill hole, we hit 38 meters of 1.55 grams per ton. And within that, there was a section, 3.7 meter section that was almost 12 grams per ton. So that's a great example of where we have this nice broad shear zone that we know is mineralized, and then you find these high grade zones within it. And we followed that up with some other, good results towards the end of our drill program, where we hit, 14 meters at 2.91 grams per ton, and some higher grade stuff where we're getting 6 meters of 5.47 grams per ton. Now, all this drilling that we've done is over about a 300-400 meter strike length, and the thing is, arguably it's up to 2 kilometers in length, but we've only drilled it to about 125 meters below surface. So in our opinion, the zone remains open to the south, to the north, and clearly at depth. So it's a great opportunity. The second one where we really did more work on this year was what we call the road cut zone. Again, it's a great target. It's over 1.6 kilometers in length. There's probably 3 or 4 shear zones in there that we know for sure we mapped. Again, from the RC program, we're getting 13 meters at 2 grams. Follow that up with some diamond drill results where we got 11 meters at almost 2 grams per ton. 5 meters at 4 grams per ton. So, again, you're seeing that those good grades, you're seeing good widths, and we don't even think there's a I won't get too deep, but there's a contact zone that brings the volcanics beside the sediment. It's a major fault. We know there's a lot of artisanal mining on that contact zone. We call it the contact zone, and we haven't even drilled that thing yet. So that's going to be plans for this coming. We're going to be starting drilling in a week or 2 here, and we're going to put some holes into that contact because we really think that's a key potential target for us for the future. And then lastly, we've got our Kote zone, which again is a new zone. There's probably a kilometer of strike length of sort of 3 sub-parallel shear zones in there. We got a phenomenal result there. We got 9 meters of almost 24 grams per ton on one of the drill holes we drilled there. Now, yes, that did have a 1 meter at 210 gram per ton sample in there. So, an incredible high grade sample in there. But if you look at that 9 meter width, it's not like it's barren and then you got a 1 meter of fantastic grade. We've got 2-3 gram material throughout that shear zone. So, it's again, it shows you that these big shear zones are mineralized, but you hit these high grade quartz carbonate veins and they can really add a lot of ounces to you. So, what we're planning on doing, again, we're going to start here in the next week or 2. We've got about a 10,000 meter drill program planned. We're going to be going back and we're going to be doing more drilling at all 3 zones. And we're going to go a little bit deeper on the Jagger zone. We're probably going to drill down to the 150, 175 meter depth just to see how that zone extends at depth. But we've just got a lot of infill drilling to do in the road cut zone and at Kote as well to understand better those systems and how they look.
Here you've got a 2.4 million ounce deposit, average grade just under 3 grams per ton, predominantly an underground operation. But when you look at the geology, the host rock we have is consistent for over 2 kilometers. So we've tested this thing and we've built the 2.4 million, or I should say Agnico's put out a 2.4 million ounce resource, which was back in 2019. So all the work that's been done really, since then, which isn't a huge amount of work, but has not really been reflected in the current resource. They're operators, so we really can't put out any technical data, but we've obviously, we've got a good understanding of the project. And, when we completed our merger, Taj Singh, our CEO, he did a full internal mine plan, and it's an incredibly healthy project. It looks like it's got a greater than $1 billion NPV, right? So, without going into huge detail, we know there's a mine here today at no more ounces. But when you look at, we've got some of our drill holes. I think our deepest hole is about 950 meters, and the rock is identical to what it is at surface. So you've got this consistency that goes down to, we know, at least 950 meters. It's not constrained. Other deposits in the area, they're 3-4 million ounces, boom, they're constrained. There's no more depth potential. This continues at depth. I mean, we have a clear plan of how we would take this to 4.5 million ounces, potentially more, just at Barsele. So the deposit is incredibly healthy, and that was back at $1,800 gold. I think Barsele had a market cap of $220 million at $1,900 gold, like 3-4 years ago.
All right. Thank you for joining us. That was a heck of a download on everything gold, silver, precious metals, Europe, you name it, Scott. We covered it all. Even a good silver asset, good gold asset? That was a fantastic download on great insights from some veterans in the industry.
Yeah, I mean, we learned a lot. We hope you did too. And make sure you stay tuned to Grizzle, research.grizzle.com. We're going to have some additional deep dives on gold coming out shortly. And then look out in November. We're going to be doing our flagship commodity live conference live on Twitter, YouTube, LinkedIn, you name it. Don't miss it.
Awesome. Guys, stay tuned for all things Grizzle. You know where to find us, research.grizzle.com. And also, without a doubt, YouTube, Twitter, you know where we are.